Hey guys, I want to talk about something that's been on my mind lately, and it's the Magnificent Seven stocks. Most people just assume because these businesses are so big and popular, they're great investments. But the thing is, not all of them deserve to be there. I've been diving deep into their financials and their fundamentals, and I've found some surprising things. Now, that Magnificent Seven stocks are stocks like Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. These companies make up 30% of the S&P 500, but not all of them, like I said, deserve to be there. If we look at my portfolio, and this shows what's in my portfolio percentage by percentage, I actually hold four of these companies. Amazon, Google, and Microsoft make up a huge part of my portfolio. I even have some Apple. But I want to discuss ones that I'm thinking about adding more and ones I'm thinking about trimming. I'm a long term investor, so I really look for companies I can hold for a long period of time with outperformance of the market as a 19-year-old that I can compound my wealth at a great return year over year. We work really hard for our money, and when we invest it, we want to make sure we're getting the greatest return in the long run as possible. So that's why I like to dive deep into great businesses. I have a lot of time to compound my wealth over time because I'm only 19. My goal is just to outperform the market and hopefully on average get 15% year over year returns. And I know that's ambitious, but I really do believe I can do it just by not following trends, not short trading, but just buying and holding these great compounding machines. So just as a preview, here's something that's very interesting. This is a chart that shows Amazon's and Apple's total revenue since 2017. Apple's the one in orange and Amazon's the one in blue. And you can see that Amazon's been averaging a CAGR of 20% revenue growth year over year, which is crazy. And Apple's 8%. And Apple's revenue growth is decelerating, which is very interesting to see. Amazon has multiple growth drivers, right? They have their e-commerce business, the advertising business, AWS, and Meta's crushing it too. They're growing about 20% year over year too. So this chart alone shows you the difference between the Mag 7 because Apple does make up like the biggest part in the S&P 500, and it's definitely something worth looking at. Today I'm going to break down all these companies, show you exactly why I rank them the way I do, and most importantly, help you understand how to analyze them yourself because at the end of the day, that's what matters, learning how to make decisions on your own. So let's go ahead and dive into it. Before we dive into these companies, I want to explain what I'm looking for because there's a lot of noise out there about these stocks. I focus on what actually matters, long-term wealth building. Let me show you using Amazon as an example because this is one of my highest conviction holdings. It's actually my biggest holding. If we look at my portfolio right here, it's this big orange slice right here. And I want to use Amazon as my first example here. So when I analyze these companies, I'm looking at three main things. First, can they grow their revenue year over year at a consistent, predictable rate? If we look at Amazon's chart here of their revenue growth, you can just see that in the last 10 years, they're averaging 21% year over year percentage increase on their revenue, and it's very predictable. You see it goes up every single quarter in the trailing 12 months, which is exactly what you want to see in revenue. Ideally, I look for companies that can grow their revenue about 8% year over year. And Amazon, they grew their revenue like 11% last year, and they're projected to keep doing it in double digits, and that's great. Second, do they have strong moats, right? Amazon's got multiple moats. They dominate e-commerce, they're a leader in cloud computing with AWS, and now they're building a massive advertising business. And this chart just shows all the moats they have and all these businesses they operate. And what I mean by a moat is when a company has advantages that are really hard for competitors to copy. And third, we gotta look at valuation. But here's the thing, I'm not going to avoid a great company just because it looks a little expensive. Right now, Amazon's trading at a 1.5% free cash flow yield. That might seem expensive to some people, but when you look at their growth potential, it's actually pretty reasonable. And this chart right here just shows the free cash flow yields of all seven of the Magnificent Seven companies. And you can see the very bottom, aka the one that's trading the most expensive, is Tesla at 0.3%, which is kind of rough. We'll be talking about them soon. Now I'm going to rank these companies from worst to best off these factors. And let me tell you, some of these may surprise you, especially what I'm thinking about Apple. But I'll show you why I'm ranking them this way, and more importantly, ways you can analyze these companies on yourself. Let's go ahead and start with number 7. Coming at number 7, this may surprise some people, it's Tesla. Now, don't get me wrong, Tesla is a revolutionary company. They've pushed the entire auto industry towards electric vehicles, and that's incredible. But as an investment right now, I'm just not convinced. First, let's look at growth. Yes, Tesla has grown rapidly in the past, but if we look at this chart of the revenue, you can clearly see that the revenue is slowing down, and a big chunk of the revenue is still tied to car sales, which are cyclical. We all know the economy goes up and down, and when times are tough, people hold off on buying new cars, right? And Tesla, they have a lot of expectations because of this self-driving market, but you just don't know how much market share they're going to really capture in that, right? And then there's the valuation. Tesla is trading at a very low free cash flow yield, around 0.3% based on 2025. And remember, a lower free cash flow yield generally means a more expensive stock. Some people argue, well, it's Tesla, it deserves a premium, but I'm looking for value and growth, and right now the valuation just doesn't make sense to me to hold this one for the long term, especially with the growth slowing down. In this chart, I'll highlight right here, they're the green one, and you can just see they're on the far right there that they're actually the lowest, most expensive stock. In other words, their expectations are very high and they have a lot priced into the stock already. Tesla's moat is another question mark towards me. They do have a brand and a supercharger network and the technology, but the competition is just fierce. Like I said, the biggest question on Tesla is their self-driving vehicles. If they actually achieve level 5 autonomy, their returns would be decent, but if they don't, that's huge revenue streams that they're going to miss, and their stock is just going to plummet because of it, and the expectations, like I said, are already priced in. Every major automaker is going all in on EVs. We're talking Ford, GM, Volkswagen, and the Chinese companies are coming in too. So it's like people think Tesla's this huge different company, but at the same time, these automakers are really doing similar things to Tesla. However, one thing about that's interesting of Tesla is their R&D spending as a percentage of revenue is 8%, which is the lowest out of all the Mag 7 stocks, which is a good thing. But as of right now, I'm not buying this company, and it's coming in at number 7. Plus, let's be honest, Tesla has a history of missing their earnings estimates. And with so much expected of the stock, if they keep missing their estimates, their stock's going to plummet. It's just too much risk for me right now. Like I said, Tesla isn't a bad company. I like the company, but as a long-term investment, I'm not looking to buy this one anytime soon. Next up at number 6, we have Apple. And this might be controversial because I actually own Apple, but I'm seriously considering selling it and moving the money to a better position. The thing is, Apple is a phenomenal company. They have an incredible brand loyalty and a fantastic ecosystem, and they just print cash. But similar to Tesla, if we just look at the revenue chart, you can see how it's just flatlined. They're projecting only around 4% growth year over year, and of a company of Apple's size, that's just not enough to me to get excited, especially when I'm aiming for 15% annualized returns. Like the S&P 500, their average revenue growth is about 10% year over year. Their whole game plan right now is to squeeze more money out of these existing customers through services like Apple Music, iCloud, Apple TV, the App Store fees, all that stuff. And don't get me wrong, the service revenue is growing about 14% year over year in the last quarter, but can they keep that up forever? I'm just not too sure. People are already starting to get annoyed with these subscriptions, I feel like, and there's alternatives to them. So personally, I don't think they can. Also, I want to talk about innovation. Where's the next big thing? The iPhone's great, but it's been around for a long time, and they're really betting big on the Apple Intelligence stuff, but we'll just have to see if that can actually give them a good return. But will it be enough to drive new revenue? I have my doubts. Plus, there's the China risk. A big chunk of Apple sales and manufacturing are tied to China, and with geopolitical tensions and China pushing its own domestic phone brands, that's a real concern to me. Finally, the valuation, right? Apple's trading at a free cash flow of 2.6%, which isn't horrible. Again, the higher the number, the better actually, the more cheaper the stock. But you can see over time it's been around that for a while. And Apple has done great stuff with their stock. But given the slow growth, I just don't see a lot of upside here. So for me, Apple's a hold, but I'm seriously on the fence. If that revenue growth doesn't pick up, or if we see more signs of trouble in China, I might be selling. All right, at number 5, we have NVIDIA. Now, this company's been on an absolute tear. The AI boom has made NVIDIA the king of the hill, and their data center revenue has exploded. I'm going to show you a chart that may surprise you. So some people think of NVIDIA and they just think of their graphic cards, their game business, but really what's been driving their growth is the data centers. This may not come as a surprise to some people who are investing. But the orange bars here show their growth in the gaming segment, which honestly has been growing 20% year over year since 2013, which isn't bad. But their data center revenue has been growing on average 77% year over year since 2013. And that's why the stock has exploded. And similar to Tesla, they have a lot expected of them in the future. Also, they built a powerful ecosystem around their CUDA software, which makes it hard for customers to switch to competitors, which is a strong moat. But the problem here is the valuation. NVIDIA is trading at a free cash flow yield at 1.72%. And they have, out of all these stocks, I think they're expected to grow the most in the next few years. So they have a lot expected of them, right? And while they dominate the AI chip market now, competition is coming. And we're talking about AMD, Intel, and even the other tech giants like Microsoft and Meta developing their own AI chips. Microsoft has their Maya processors and Meta with their MTIA chips. NVIDIA's market share is likely to come down, in my opinion. So NVIDIA is an amazing company, and I do like them. But for me, they're not a buy. They're just on my watch list right now. And if you're holding them, I continue to hold them. But I'm not really looking at getting into this company as of right now. Coming in at number 4, we have Microsoft. Microsoft is a powerhouse. They've got their hands in everything. Cloud computing with Azure, operating systems with Windows, gaming with Xbox, productivity software with Office, which a bunch of Fortune 500 companies use. And they're just entrenched themselves in this moat, right? And if we look at the revenue chart right here, you can see the growth over time. Their cloud revenue is growing at a solid clip driven by demand for AI services. And they're talking about AI contributing 700 basis points to Azure's growth, which is pretty huge. And I don't want to forget about Copilot. Microsoft's integrating AI into everything, right? And they're charging a premium for it, and businesses are actually paying for it. They're saying 75% of Fortune 500 companies are using Copilot, and that could generate billions in recurring revenue. And in my opinion, that's just a smart move by Microsoft to spend so much capex on AI because it is the future for their business. The valuation is a bit of concern. Microsoft's trading at around 30x enterprise value to free cash flow. That's high, but given the diverse business, their strong growth, and leadership in AI, I think it's more justified than NVIDIA's. So Microsoft's a strong company, and I'm happy to hold it in my portfolio, but the valuation keeps it from being higher on my list. In my portfolio, Microsoft is one of my bigger tech positions, and you can see here that it hasn't really done much since I've held them, but I am confident in holding them in the long run. Coming in at number 3, we have Meta. I know a lot of people are down with Meta because of the metaverse thing, but I don't really get it because their stock has done really well lately. I've been watching Meta really closely lately. I'm actually really impressed with what they've done. They've pivoted to AI lately, and it's really paying off in their advertising business, which is still growing 20% year over year. So you can actually see their advertising business is actually accelerating, which is crazy because they've already reached like 3.5 billion year over year. And this chart just kind of reflects that. So it's a crazy thing Meta continues to do this. And they're using AI to make their advertising more effective towards their customers and more valuable to advertisers, right? Their Advantage Plus campaigns are automating a lot of these ad creation processes, and it's driving down costs for businesses. And like I said earlier, billions of people use Facebook, Instagram, and WhatsApp every single day. That's a huge advantage. This chart actually shows you the family daily active people that are using Meta year over year, and you can just see that they're continuing to grow this 5% year over year, and it's already at 3.3 billion people. Now you do have to wonder when this does have to slow down eventually because there's a finite amount of people in this globe, but the fact that they continue to grow it is, like I said earlier, very impressive. And out of all these companies, if you just look at the free cash flow yield, which is right here, they're actually trading right now at 3% free cash flow yield, which is actually pretty reasonable for this company. So I like the valuation when it comes to Meta. Now, about the Reality Labs stuff, like their VR headsets in the metaverse, it's a big question. They're actually losing money on it. They're not even making a profit, but they've shifted a big chunk of the budget towards AI, and I think it's a smart move. So Meta is a company with a strong core business and a massive user base, a growing advertising business powered by AI, and surprisingly, a reasonable valuation in my opinion. So that's why I put it on number 3. I think it's just a great company to hold long term. And it's certainly a watch list. At number 2, we have Alphabet, which is the parent company of Google. And Google, they're the owners of YouTube. You have Google Search, which their advertising business is massive too, similar to Meta. And they certainly have a moat. And just like Meta too, they're really doubling down on this AI stuff. Their search ad business is still the king. Even with all the talk about the AI chatbots, people are still using Google search billions of times a day, and they're finding ways to integrate AI into search, making it even more valuable. Plus, Google Cloud is growing rapidly, gaining market share and becoming a major player in the cloud space. Like if we look at the chart right here, it kind of shows the cloud market share over time. It only goes to 2022, but trust me, even when you go beyond that, Google Cloud is catching up to Microsoft and AWS when it comes to the cloud business. And I think they're the fastest growing one. It's either them or Microsoft, but the cloud business is huge for Google and they're improving their margins on it over time. And they're getting more market share, which is very exciting. Plus, out of all these companies, Google is by far the cheapest one when it comes to free cash flow yield and their PE ratio, which we'll look for all the companies later on. Their free cash flow yield's almost at a 4% right now. And for a company of the size of Google and how fast they're growing, to me, that's actually a really good deal. So Alphabet is definitely a diversified tech giant, and they have multiple market streams, a strong brand, they have innovation, reasonable valuation, and to me, it's a fantastic long-term investment. And if we look at my portfolio, it's exactly why I have a lot invested in this company. But then it's going to foreshadow number 1 because number 1 is just right above it. And the number 1 Magnificent 7 stock I think you can buy today is Amazon. For the long term, we're talking 5-10 years out. Amazon isn't just an e-commerce company. They're a technology company with their hands in everything. First, you have AWS, Amazon Web Services. It's the leader in cloud computing, and they have a massive market share where they're growing at a healthy clip, and the margins of AWS are pretty incredible. And here's their revenue by segment. They have a logistics network that's pretty unmatched with Prime delivery getting faster and faster. And then there's this advertising business, and this is, in my opinion, the hidden gem when it comes to Amazon. Look how fast they're growing their advertising business. It's growing last 2 years on average by 26%. And their advertising business really just comes down to, there's Prime stuff, like their online store. They have a huge leverage when it comes to that, and people are going to pay to advertise on Amazon because that's where everyone goes. In fact, Amazon's ad revenue is growing faster than both Google's and Meta's, and they have incredibly valuable data on what people buy, like I said. That makes their ads super effective. And they're also investing heavily into AI, and overall, they're consistently innovating and expanding their reach. And while the valuation isn't cheap, it's reasonable considering their growth potential. When you look at the free cash flow they're generating and you project that out for the next 5-10 years, the current price starts to look attractive. Amazon has a wider moat than any of the other Mag 7 companies, and they dominate multiple categories, just in my opinion. So Amazon has it all. They have multiple revenue streams. They're innovating well, they're using AI, and they're growing the fastest. And that's why I put them number 1 on my Mag 7 list. All right, so that's my rankings of the Mag 7 stocks. I know it may be controversial, especially putting Tesla at number 7 and Apple at number 6, but it's just my own research. And the key takeaways here is to do your own research on these stocks. Don't just blindly follow the crowd or the headlines. Don't follow trends. Look at the fundamentals. Look at the growth of these companies. And if you think they're a good long-term, look at the valuation. And when the time is right, you could easily buy into these companies. So I want to know what your rankings are in the Mag 7 companies. I want to know in the comments down below if you own any of them, because I like responding to all my comments. I'm very interested to hear what you guys have to say about investing and your long-term approach when it comes to investing and how you're building wealth time. And I want to know your thoughts when it comes to these 7 companies and if you're holding them, or maybe you're a bear, or if you're a bull on them. So let me know down below. Subscribe if you want more tips on investing and following my journey, my portfolio over time in this channel. I'll always track this portfolio right here, which is doing well. And this just shows the holdings I have right now. And I believe in these companies in the long term. And if you just want to follow along, please hit that subscribe button because it's going to be very interesting in the years to come. That's going to be it for today's video. So hope you liked it, and I'll see you in the next one.